All right. So those of us who have our hand raised, you can drop them now. You can drop them now. All right. So today we'll be looking at leverage, margin, free margin, margin call. Margin call. Let me just go down and see. Okay, so that's before margin, before candlestick anatomy. Okay. All right. So now in Forex, margin refers to the amount of money a trader needs to deposit to open and maintain a leveraged position. Okay. So for you to enter any trade, there is what is called margin. That margin is the amount set aside. Okay. So now let's look at this. Let's look at this image again. Now, can you see this image here now? You see this $8.87. This is the margin. Now, this margin is constant. It will only change when you add a new position or one position closes. All right? It will only change when you add a new position or one of the running position closes, because this is what you have put down to be on the trade you are in right now. Now, this one and your balance are constant. They don't move until a trade is closed. So when trades are running, your equity will be changing, your free margin will be changing, and your margin level percentage will be changing. So these digits will be changing per time. They'll just be changing, you know, depending on what is happening around the trade. Okay. So margin is the amount you pay, you drop, you deposit, all right, to enter a trade. Now, there are some assets that has very high margin. Some assets have very high margin, while some other assets have very low margin. So there are some assets you cannot trade with a particular amount. So let's assume you have $10 and there is an asset that the margin to trade that asset is $10. You cannot trade that asset because you need $10 to set aside before you now talk of the one you now use to enter the trade. So that is what margin is. All right, so let's go back to the definition. Okay, it acts as a good faith deposit or collateral. Now, the broker does not lose. Whether you are buying or you are selling, the broker does not do what? Does not lose. So if at the end of the day, you blow your account, there is the one that is set aside is no longer in your account. So that is where whether spread or commission will be taken from. Okay. And apart from that, in some cases, now where you have, when we go to the chart, you will see that the leverage has difference, as in because the spread, you see the gap between the ask and the bid, which is the spread difference. You see sometimes if it is wide, you see the difference in the line. You see it on the chart. I'll show you when we get there. That's why it happens that Mr. A and Mr. B take the same trade, but they are working with different broker. Mr. A trade must have hit in TP, but Mr. B trade is still lagging behind, and at the end of the day may not even hit TP before the trade will reverse. So that is another area that the spread plays, you know. I'm talking about what is set aside and the spread. Okay. All right. So let's now look. Say here is the breakdown. Number one, leverage. We talked about leverage yesterday. That's the what the room the broker give you to go into the pool of the market. Now, Forex is often traded on margin, which means you can control a large portion with a relatively small amount of capital. For example, with leverage 1:100 leverage, you can control a $10,000 account with just $1,000 in your own money. I explained this in detail yesterday, all right? So what it simply means is that, say 1:100, it means that your $1 is seen as $100 in the market. So if your leverage is 1:1,000, your $1 is seen as 1,000 in the market. So in this case, in this example now, what is used is $100. I mean, 100 as leverage. So that is why you have it as $100,000 with your own $1,000. All right, so now let's look at the margin, type of margins. Okay, so now type of margin. Initial margin. So which is the one I showed you on that image? That's your initial margin. This is the amount required to open a position. Maintenance margin. This minimum amount needed to keep a position open. If your balance falls below this level, you could face a margin call. Now, free margin. Free margin is the available amount in your account to open a new position or withstand drawdown. Now, let's go back to that image again. Now, this is free margin. Now, this is your balance. Your balance is 1,409.34. Okay? Now, your equity. Now, your equity is always plus or minus your current profit and loss. Now, this $66.85 is your current profit and loss. Not until this is closed, it is not your money. It is when it has closed before it will now be added to your balance. But for the fact that this trade is still running, it is called floating loss or floating profit. So your equity here now is plus or minus your floating loss and floating profit. Okay? So now your free margin is the amount available for you to take trade. So because you are in profit right now, your free margin is still big, all right? Because it's working with your equity. Okay, it's working with your equity. So this is your free margin. Now, your margin level percentage, let me know, we'll get there, okay? So let's go back to the definitions. The margin call. Margin call. Now, a margin call is actually a call done by the broker to you, and this is automated, all right? The system is designed and functioned in such a way that as all of this happen, when your account goes down to a level, so let's assume you are having a drawdown. A drawdown is when you are in negative, okay? A drawdown is when you are in negative. So a margin call is when your, sorry. Okay, so when your margin level percentage come below 100%, then you have reached margin call. By that time, all of this equity balance, all of them will be showing red. Okay, all of them will be showing red. So now the broker will now send you a message via email to say your account has dropped below so percentage. All right, some of them put it from 80%. They will start sending you message. So your account balance has fallen below 80%. Make a deposit to sustain your account. As it fall below 90, it will alert you. As it fall below 95, it will alert you. And the next thing you will hear, the account has been closed. That is what we call blowing of account. So you have blown the account in that case. All right. So that is where your margin call comes in, when your margin level percentage fall below 100, because your account has become red as at that time. I think there are other, okay, margin call. Okay, so now let's continue. Okay, so margin required. So your trade size divided by leverage, that is how the margin is calculated. Okay, so for example, if you are trading one standard lot, we will come to lots, okay? We'll come to lot size, okay? When you are trading one standard lot, 100,000 units on, you're trading one standard lot, 100,000 units on Euro USD with 1.1 leverage, your required margin is equal to 100,000 divide 100 equals to, so do the arithmetic, that becomes your required margin to set aside, okay? All right, so we'll be going straight to the next one now, which is the candlestick analysis, candlestick anatomy. This is where the Forex is, okay? This is where Forex is. There is actually a great, we'll be going to the charts today to look through this one now. We're going to the charts and we'll look through this critically, all right? So here is breakdown of candlestick anatomy, commonly used in technical analysis of financial markets, stocks, Forex, crypto. Now, we've talked about instruments, what is traded in Forex, all right? So everything that is traded on that platform uses charts, okay? And what we see on the chart, there are different types of candlestick, or you may call them chart pattern. All right. I mean, chart representation. We have the line chart. Okay. We have the holo candle. We have the hekineshi. We have the Japanese candlestick. And technically, we work with the Japanese candlestick. And it is the Japanese candlestick that it's used for technical analysis and in every educational platform. And that's what we are using here as well. So please take this seriously, all right? Because you really want to know Forex, you really want to know how to analyze trade, you must understand what a candlestick is, all right? You must understand what a candlestick is. And one thing you also need to know is that candlestick formation is candlestick formation, all right? Irrespective of the time frame, whether it is 1 minute, 1 hour, daily, 4 hours, the formation is the formation. The only thing that is different is that for each of this time frame, it takes that whole time for a full candle to form, to open and close. All right, so basic component of a candlestick. So a candlestick has body, which is the real body. Now, the rectangular area between the open and close of the price, that is called the body. Now, we have the bullish candle and we have the bearish candle. Now, the bullish candle is often represented by green or white. Close price is higher than the open price, all right? So the opening price of a bullish candle, all right, is lower than the closing price. It's simple. We'll get to that. You will have a better understanding. And the beautiful thing is that we're still going to go into the chart, live chart, and we'll look at all of it. Then we have the bearish candle. So bullish is buy, while bearish is sell. So we have the sell candle, we have the buy candle. So the bearish candle, often represented by red or black, close price is lower than the open price. All right, so let's continue. So now this is how a candlestick looks like. But before we come back to the image, let's now look at what is called the wick. Now, the wick or shadow, this is the thin line above or below the body. Okay, the thin line above or below the body. So this is a candlestick. This is a candlestick. I believe you can see my cursor, right? This is my cursor. Please, if you can see my cursor, just type yes on the chat box. I can't hear anything. What is going on? Please, you have to check your own system or your whatever your audio means it's, because every other person can hear me if you cannot hear me. All right. Okay, so you can see my cursor. All right, so let's look at this bullish candle. This is a green candle, is a bullish candle. All right, so now a bullish candle develops up. When I mean it develops up, it starts from bottom, all right, and closes at the top. Okay, it opens from the bottom and closes at the top. So for a bullish candle, the opening price is always lower than the closing price. The opening price is always lower than the closing price. Now, let me use Naira for instance. Okay, so a bullish candle is a buy candle. So what it means is that if you find a candle, the price that opens the candle maybe is 10 Naira, and by the time the candle is closing is now 15 Naira. So you see that because the price is going up, the bottom is lower. So that was where the candle started from, all right? So the entry, the open is lower than the close because the close is on top. So that is for bullish candle. Now, we also have, every candle have a high and a low. Every candle has a high and a low. In the case of this candle, you see this week, top of this week, this is the high. I believe the arrow is showing you this is the high and this is the close, okay? Where the green body ends, that is the close of the candle. Then this is open. The open is where this body also ends. And this wick, this very bottom is the low of the candle. So every candle develops what we call OHLC. OHLC. Open, high, low, close. OHLC. Open, high, low, close is on every chart. You see it when we go into the live market chart. I will also show you, you see the OHLC. All right. So now let's now look at the bearish candle. Now for the bearish candle, all right, the open is on top while the close is below. The open is on top while the close is below. Now every bearish candle opens at the top and closes below. So let's use that same illustration of Naira. So let's assume you sold okay, so the bearish candle, now you enter, the candle started with 10 Naira and it started going down. The close is definitely always below that 10 Naira. So the candle formed at 10 Naira and closed at 5 Naira. Why? Because it's going down, it's a sell. So for that reason, the opening price, all right, is on top, is usually higher than the closing price. Then you also have the wick up and down. Now the wick up is the high, while the wick low is the low. Now let's look at these two candles critically, the bearish and the bullish. This is the bullish, this is the bearish. What is the difference? What can you see about the labeling? Now, the low and the high of every candle is the same. The low is the bottom, the high is the up. Whether it's a sell or is a buy. Whether it's a bullish candle or it's a bearish candle, the low is the bottom, while the high is the top. All right, the wick on top is the high. The low is the wick below, the very low of the wick is the low. Now, the only difference between the opening candle, the bearish candle and the bullish candle is the open and close. All right. In the case of the bullish candle, the candle opens at the bottom and closes at the top. While in the case of the bearish candle, the candle opens at the top and closes at the bottom. So this is what is called the candlestick anatomy. All right. Those medical students who did human anatomy, you know what anatomy means. It is study of the parts of the body. Every part of the body, trying to understand each part of the body is human anatomy. So when we're in school then, I think there are some general studies on biology then that talks the early stage of human anatomy, and it is handled by the College of Health Sciences. Okay, so but here we are talking about the candlestick anatomy. So we're talking about the candlestick, the part of the candle. We are describing every part of it. Okay, so let's go to the next page and see. So exactly what I have explained is what is still being explained here, all right? So let's just look at them. Now, the upper wick is the high of the session, while the lower wick is the low of the session. Now, let me go back to that image and just explain something to you. Now, how did this wick form? This wick now, this shadow, how did it form? Now, what it means is that when this candle opens, all right, when this candle opens, at a time, it started going down, all right? So this candle you see like this, it was first of all bearish. It went bearish, but the bear could not sustain it and now pushed it back up, all right? Back to his open, and that is when it now became green again and produced this body. So now this green you are seeing did not just end here. This green actually came to the very top like this, but could not sustain it before that period is over. It now pushed down. So pushing down was what produced this wick. So that is how wicks are produced. Now, this same thing applied to this bearish candle. So this bearish candle was actually opened here, but at the time when the candle opened, the first thing it did was to go bullish. So the candle first of all went up. It went up, but could not sustain the up, and it came down again to the open and continued downward. Now, it did not just end here at the close. It pushed down to this very bottom, but could not sustain it and pushed back up a bit before that time frame was over. So this is how this wick is produced. Now, you can have a candle that have no wick at the top or no wick at the bottom. You can have a full-fledged candle that you will not see a wick at all. All right? So that is how the wick or the shadow is formed. Okay? So the open price, say the price at which the asset opened during the time period. So when we're talking about the time period, we're talking about the time frame, because every candle forms with a time frame. We have different time frame. We have even 1 second is a time frame. 2 seconds, 3 seconds, 10 seconds, 1 minute, 2 minutes, 3 minutes. They are all time frame, and we work with this time frame to do our analysis using these candles. Okay, so close price. Say the price at which the asset closed during this period. Now let's look at the high. The high price, say the highest price reached during that period. So you see that the price actually reached but could not sustain in some cases. All right, so when you have a candle with a full body without wick, The open and close will also serve as the high and low, depending whether it is bearish or bullish. I believe that is clear, okay? If you have a candle without a wick, the open and close is also termed as the high and low, depending on whether it is bearish or bullish candle. All right, let me see. I think okay, so this should be in response to my first, when I was asking about, okay, ninth one. Okay, it is. All right, so now we are going to go straight into the chart, okay? We're going to go straight into the chart. So let me stop. Okay, okay, is it the same share? So let me go to the chart now. All right, so this is actually a chart, all right? This is actually a chart. Okay, so now the same candles we are talking about now, you'll be seeing it live here now. All right, the candle, you'll be seeing it live here now. All right, so this is a live chart, right? And this is 5 minutes time frame. Okay, this is the time frame here, 5 minutes. This is 5 minutes time frame. So you can actually change time frame. All right, so let me go to daily. This is daily time frame. So what it simply means is that every candle that you see here take 1 day to form. Every candle that you see here take 1 day to form. So this is today's candle. This one here, the last one now, is today's candle. All right, so this candle opened today. When this candle first opened, it went down. So that is, you can see that it has a wick, right? The candle has a wick. Let me show you the bottom of the wick. Now this is the wick. There's the bottom, okay? So what I just dropped now, that is the low of today. This is the low created. Presently, the candle is still with a full body. And today has not closed. The market has not closed for today. So the market is not closing anyway, but the time frame, so we need to go into tomorrow for this candle because this is daily candle, all right? Okay, so and we enter into a new day on this by 10 a.m. All right, because that's when the market opened, that's the day start counting. Okay, so for now, this candle is bullish, but when it started bearish. So if you were here when this candle first made this move, it would have been red. You see it as red. But because you did not see it that time, it's now green. Because as soon as it came back and pushed into this level with this guy, which is the open, it will now turn to green. So this is the candle, the same candle you have seen, but now this is a live chart. So I'm going to go to 1 minute so that you will see it clearly. We want to see a candle making move right now, okay? Okay, so can we see this candle now? Because this is 1 minute, it's moving. You can see it now, okay? Because 1 minute, we can wait for it and see it. So this is a candle now. This candle is bullish. They want to see how this candle will close. It did not produce, okay, they produce a very tiny wick at the bottom. You may not really see it well. Okay, so let's wait how many seconds for this candle to close. Let me do something so that we'll be seeing how many seconds for each candle or scale time, show candle. Yes, okay. All right, so you can see it's remaining 10 seconds for the candle to close. Remaining 8 seconds, 6 seconds, 5 seconds, 4 seconds, 2 seconds, 1 second. A new candle is going to form now. Okay, so can you see this candle now? This candle started by going down. Did you see it? So let's see how this candle will close. It started by going down. That's why it's showing red. But as soon as it picks from that level, it will now show green. So it is at the end of the closing of the candle that we'll be able to tell whether it has wick up or wick down and all of that. So if you can see this last candle that just closed, you may hardly see a wick, but there is a small wick, very tiny, okay, that is showing right now, but you may not see. So that's why I tell you that sometimes you may have candles without a wick at all. Some may have wick at the bottom and may have no wick at the top. Some may have at the top, may have no wick at the bottom. So can you see what happened now? It went down this much. It went down this much, all right? Okay, so you can see now it created a wick above and a wick below. Another candle is coming now. So let's see. So it's going down first, okay, trying to go down. All right, so let's see how this candle will close. Let's see if it will close bullish or bearish. But from what I can see, this candle is going to close bearish. And if it does not close bearish, it will have a wick as long to this level where it is right now, just like what you saw here. This guy came here first. So the same thing you are seeing on this 1 minute is exactly what has happened on every other time frame. There's just that it takes that long a time for that candle to form and complete. I believe this is making sense. If it's making sense, are you getting value? If you are getting value, put 111 on the chart box. If you are getting value, put 111 on the chart box. You just explained to us what happened between the low and the, okay, yes, of course. You know, I try to want to break it down to just understanding so that, you know, when you see it, you know, sometimes we may not really understand what these things are. When you just see them, they look like magic. There's nothing magical about them. It's just the understanding. So this candle is remaining how many minutes to close? It's remaining at 27 seconds to close and is going massively bearish. It did not create a wick at the top, so it opened and just started coming down. So this candle may close bearish as it is like this now, all right? The candle may close bearish as it is like this now. It's going to close with 6 seconds left, 5 seconds left, 4 seconds left, okay? So you can see that it produced a wick at the bottom, okay? All right, so this one now, you know, it's a bearish candle. Can you see this one now? It started with bull, right? Started with green. But don't be surprised, this candle can still end up to be a bearish candle. And it will produce a wick as long as the movement it has made before the red will form. Okay? It may not produce as well. It may continue as a bullish candle as well. So one thing you want to note is that wherever the previous candle closes, that is where the new one opens. All right? Wherever the previous candle closes, that is where the new one opens. So the closing price of the previous candle is the opening price of the new candle. Can you capture that on your notebook? The closing price of the previous candle is the opening price of a new candle. Whether it is daily, whether it is weekly, whether it's monthly, 1 minute, 1 hour, 1 second, where it closes, that is where the new one opens. Whether it is a buy or sell that is going to form next, that is how it works. So this is candlestick anatomy, and what's the time now? 45. So we still have some time. So let's go back to, I believe this is just the first thing you need to know about the candle. You just need to know the candlesticks itself, which is what I believe I have given to you now. We'll be visiting this chart again. Next time we'll be visiting it when we'll be talking about trend. All right, we'll be talking about trend. We'll be talking about support and resistance. We'll be talking about what else? When we come to this chart, we'll be talking about consolidation, trending. Is the market trending? Is it consolidation? Is it uptrend, downtrend? That's where we'll visit the chart again, and we'll do some practical, and we may even take a trade on your demo account on such a day. All right. So if you have not set up your account, I drop videos on how to to create your demo, to create your account, you know, and all of that. I drop a video when I say you should download MT5 and the rest. So if you have not done that, make sure you do all of it so that you are not left behind. So let's go back to the, let's see what we have next. So what we have next is risk management, okay? Risk management, okay? This risk management is supposed to come, trend and support is supposed to come. I think I may have, okay, so let's go to risk management, okay? Let's go to risk management. Let's push faster than what we have on the chart, on the timetable, right? So let's go to risk management. So we can do something for the next 20 minutes and we use the balance remaining time for question, okay? So we still have 42 minutes. So if we can use 20 minutes to take this, then we use the balance of 22 minutes for questions and answer before we shut down today. Okay, so risk management. Risk management. What is risk management? So risk management in Forex trading is critical for long-term success and to protect your capital from major losses. Here are key principles and technique used in Forex risk management. Okay, so as the term is very simple, the term risk management, you are managing your risk. You don't want to expose your entire money to the market, okay? Because if you expose your entire money to the market, then if anything happens, you lose your capital. And as soon as you lose your capital, you are out of business. There's no businessman, no business person that want to just expose everything he or she has to risk. You want to protect your capital so that you can have a sustained business. But if you expose everything and you lose everything, you are out of business. So in the same vein, if you are trading in the Forex market, you don't need to expose your entire capital. You need to just set out a quota of that capital to trade per time. All right, so you're setting a percentage for a trade. You want to risk a particular size of your account to trade a particular asset. So let's assume you are trading, you have a $100 account and you want to trade. Now, you can expose, you say you want to expose only 3% of that $100, and 3% of $100 is $3. So if you lose $3, have you lost the entire account? No. So that is risk management. So you expose that $3 and you say, so let's assume you are taking a trade now, your stop loss is $3. And maybe the take profit you are pursuing for that trade maybe may even be $10 or $6 or $7. So you are saying that you are setting this money aside to pursue this trade. So you are setting $3 aside to pursue $10. And if things goes well, you get that $10, that $10 is added to your equity. All right. But if things go the other way, what happened? That $3 goes out of your account. That is risk management. It's as simple as that. Now, there are indicators to set this risk management in your account. All right. So the first of them is the use of stop loss. Okay. So now, there is this saying in the Forex market that if you stop using stop loss, you will eventually stop trading. And it's very true. If you stop using stop loss, you will eventually stop trading. Because when you do not use stop loss, you blow your account. Every now and then you are looking for money to fund your account. Now you will fund your account to a level that you will look left, right, center. There's no money to fund your account again. And what happened? You will stop trading. Is it not so? So trading with stop loss is the first thing you must learn in this market, because that is the only way you preserve your account. So the use of stop loss, always set a stop loss level on every trade to cap your potential losses. Helps you stay disciplined and avoid emotional decisions. Now, proper position sizing. Proper position sizing. Never risk more than 1 to 2% of your trading capital on a single trade. Okay, the same thing I just explained now, but I use 3%. Okay, But this is saying never expose more than 1 to 2% of your account, all right, on a single trade. Adjust your lot size based on your stop loss distance and account balance. Okay, now when we get to, we're going to get to all of that. We're going to get to the lot size, your pips count and all of that. Those are the things you use, okay? Leverage control, all right? We've talked about this leverage control when we're talking about the broker, okay? Now, you know that your leverage is what gives you room in the market, okay? So if you have a high leverage, it increases your potential because, like I said earlier, is a two-edged sword. It makes your money, it makes your money big and you have enough room to play in the market. In the same vein, when it goes the other side too, it exposes you big. So leverage control, avoid using excessive leverage. High leverage increase both potential profits and losses. Okay, the same thing I just tried to explain. Stick to lower leverage ratios to manage risk better. So now let's look at risk to reward ratio. Now, when you're entering a trade, there is what is called risk to reward ratio. So when I was trying to explain that 3% on your $100 account, I talked about maybe you are putting down, you say, okay, if the trade goes against you, you are going to be losing $3. And meanwhile, your trade is pursuing either $10, $6, $7. So that is your risk to reward ratio. So if your take profit is $9, which means your risk to reward is 1:3. If your take profit is $6, your risk to reward is 1:2. If your take profit is $3, your risk to reward is 1:1. Okay, so that is how your risk to reward ratio work. And if you have trades that have good risk to reward ratio, so let's assume you are entering 3 trades. You enter 4 trades with good risk to reward ratio. So let's say all the 4 trades has 1 to 3 risk to reward ratio. Now, if you lose 2 trades and win 2 trades, you are still going to win big. Because if you lose 2 trades, you'll be losing 2, right? But the 2 trades you won, you are winning 6. So if you take away that 2 from your 6, you still have 4 as profits. It may not be clear now, but as we go on the journey, you understand this risk to reward ratio thing. There are people here who have been there who already understand this, all right? So talking about it like this more now, it's better explained for them now because their understanding will now be wider and broader. But for you who may be hearing it for the first time, you may not really grab it now, but over time, it will begin to make sense. Okay, so diversification. Now, what diversification means is, say, don't concentrate your trade on a single currency pair. Spread risk across multiple assets, all right, or across multiple instruments or currency pair. Now, the thing is that when we say you take 3 or 4 trades, it's better that you are taking that 3 or 4 trades on different instruments than taking 3 or 4 trades on one instrument. Okay, because if you take 3 or 4 trades on different instruments, even if one goes into a loss, the other 2 or 3 may be the one you profit from. But if you are trading only one asset and you are entering 3, 4, 5 positions, and if the trade goes wrong, which means your entire positions has gone wrong. Although in the same vein, if it goes well, it has gone well for you. But it does not make practical sense that you keep trading multiple positions on a single asset. Instead, spread it across 3 or 4 assets when you are trading at the same time. So you look at Euro GBP, all right, Euro USD, GBP USD, maybe gold. You are trading different 4 assets at the same time. Now, there's no way you will lose all these four at the same time. Then you don't know what you are doing. Because if you know what you are doing, basically, you cannot lose all of them. It's not possible, except you don't know what you are doing, just like I have said. So if you understand the market, you know what happens, you know how to analyze your trade, you know how to mix both fundamentals and technicals and, you know, sentimental, and you take 4 trades, at least 2 out of those 4 should be able to give you profits. Stay updated on market news. Now, in this market, especially the Forex market, the crypto market, the stock, all of those things are controlled by fundamentals. Now, I have explained fundamentals earlier, but we are still going to come to it and we'll have it broken down. Now, the news, we have economic news. Those economic news are calendar news. Now, those ones are dated, okay? So those dated ones, you will know that this thing is about to happen. We want to wait for the outcome. Those are calendar news. We call them micro fundamentals. They are micro. Now, we also have the macro. Those macro, you don't have control over them. You don't know that they are going to happen. You just be here, all of a sudden, you just hear that Ukraine just dropped 1 missile on Russia. Okay? So that one is macro. All right? And that has a way of affecting those currencies as well. So if you are trading against that currency, you know, Ukraine is Europe, okay? So every country that has a stable economy in the Europe, like the Germany, UK, you know, name them, Italy, all of them has a way, whenever things are happening, all right, it affects the currency, so which is euro at that time. So that one is, those ones are called macro. Or maybe the president speaks, all right, like President Trump now, his words, all right, his pronouncements are powerful, okay? Trump can just wake up today now and he say, we are cutting ties with China. We have no business with China again, this, that. One just pronouncement like that, there's a way it will affect, all right, the Chinese yuan. Then, on the other hand, we'll now have sentimental play around these two currencies. Now, where the sentiment comes in is how the people feel. What is going to happen with what Trump has said about this, you know, and all of that. Before you know it, some people are weighing to the positive side, so are weighing to the negative side. So that is what is called sentimental analysis. And we're going to show you the indicators for sentimental analysis when we get to the analysis. So when the markets say, stay updated to, we're talking about risk management now. Don't get it wrong. We are on risk management. So stay updated on market news is so that you know exactly how to manage your trade at this kind of time, okay? Say be aware of economic news and geopolitical events that can cause volatility. Avoid trading during major news events if you are risk averse, okay? Now, another bullet there is overtrading. Now, in this Forex market, there's what is called overtrading. Now, if you are trading without a trading plan, definitely you will overtrade. You want to trade money tonight, you want to trade 24 hours. Sometimes it becomes overtrading. It happens to all of us, but you need to have control, all right? Now, you should be able to know that if you have a trading plan, you should be able to tell yourself that my daily target is 10%, is 2%, is 3%. As soon as you achieve that percentage, leave the market alone. As soon as you achieve that for that day, do what? Leave the market alone. Because if you do not leave the market, the small profit you have collected, you give it back to the market and still give from your capital that you already had made profit, but instead this time now, you will now be the one counting losses. So that can happen through overtrading. So stick to your trading plan and avoid chasing the market. Overtrading increased exposure and emotional decision making. Now, when you make decisions emotionally, you don't know when to close and when to open. You just, you already have a trade that has take profit and stop loss. But because you just make rash decision, you just see one long candle just by boom. You just say, let me close it now before the thing will finish my money. Meanwhile, that same trade did not hit your stop loss. The trade came and hit TP, but you have closed that trade out of fear, out of emotions, in a loss. So instead of collecting the profit that others have collected from that same market, in your own case, you are collecting a loss. That is emotional decision. So number 8, you need to have emotional discipline. Now, there's one thing in this market that is called trade psychology. That is where your emotions comes in. If you know this market in and out 100%, you can analyze, you are good with the charts and all of that. If you are not stable emotionally, you don't have a good trade psychology, all right, you'll be making rash decisions, and at the end of the day, you won't be profitable. So you must have that emotional discipline. Say, stay calm and follow your trading strategy, regardless of winning or losing streaks. Fear and greed are common pitfalls for Forex traders. Okay, regular performance review, analyze your trades and risk management practices regularly. Adjust your strategy based on what works for you and what doesn't work. All right, so still on risk management, let's now come to Coco, the pips. All right. Pips. What is a pip? So in the market, in the Forex market, the movement in price, okay, is called pips. All right, P-I-P-S. Pip, one is pip. All right, but plenty is pips. So when it's more than one, it becomes pips. That one pip is one. So Naira, okay, so let's assume in the morning, Naira was 10. Okay, let's use the current market price now. So in the morning, Naira was 1,600 per dollar. But by the time the market is closing this evening now, Naira is 1,500 per dollar. So what has happened is that it has moved 100 Naira distance. And that 100 Naira distance, it can be 10 to be 10 pips. It can be 10 to be 100 pips, depending on the count. And it work with the decimal places in this case, okay? So let's look at, okay, the definition say, pip stands for price, okay, percentage in points, okay? Please take note of this. They are very simple, though. If you go through a system where you write exam, all right, these are the kind of questions they ask you. When we did IML in those days, all right, you do exam in the back office. If you want to do it, it's not compulsory. So for you to pass stage 1, these are the kind of questions you answer. Okay, so PIP stands for percentage in points or price interest points. Those are the two definitions. Those are just the two. You can either call it price interest points or percentage in points. And it's the smallest price movement that a currency pair can make based on Forex market convention. Here is a quick breakdown. In most currency pair, 1 pip equals to 0.001. All right, which is the 4th decimal place. For example, we are going into arithmetic right now. You need to get your pen and paper at this time because we'll also go to the chart and okay, someone say come back and explain about the risk to reward ratio. I think I was explicit enough. When it's time for question and answer, you can come back with your own. Okay. So for example, Euro USD moves from 1.1 100 to 1.1005. That means it has moved 5 pips move. Is it clear? Now, Euro USD, and we are going to the chart to use Euro USD. Say Euro USD moved from 1.1000 to 1.1005. What has happened is that this 5 that is added is 5 pips. So it has moved 5 pips move. For pairs involving the JPY, like the USD JPY, all right, 1 pip equals to 0.01, the second decimal place, okay? For example, if USD JPY move 110.25 to 110.35, it has moved 10 pips move. Okay, so now let me go to the chart and show us something. Okay, so let me not go to the chart. Let me just let me share my whiteboard. Let me stop share. Okay, let me share a new whiteboard instead. All right, so can you see my board? Can you see my whiteboard? Okay, so now we have 2 class of pairs. Someone is messing up with my screen. Okay, so like the Euro USD, okay, we have the Euro AUD, okay, we have the Euro NZD, we have the Euro CAD, we have the Euro GBP, we have the USD NZD. Now, okay, sorry, I didn't. Now you see all of these pairs. Now all of these pairs are these ones here now. So these ones here, someone is just messing with my screen. Who is that? Where's I'm trying to get okay. Please stop painting my screen for me, Umbok. All right. Okay, so this I think I need to, this thing is not giving me what I wanted. Let me stop share. Okay, so let me do what I want to do in a Word document. Okay, so please take this seriously. Now, those I listed like Euro, USD, GBP, USD, Euro, AUD. All of these are currency pairs. Euro, NZD. So now these pairs outside JPY. Now, please, every currency after JPY are to 4 decimal points. All right. So you are calculating these ones with 4 decimal points. So you'll be calculating them in this manner. So let's assume all of these come in maybe 1.98120. All right, that's the price. Okay. Okay. So now you want to calculate the, let me make this bold so that we'll be seeing very clearly. Okay, so you want to calculate this now. You remove this last digit, which is the 5th decimal place. All right. So this last one is removed from your calculation. Is after you have done your calculation before you now bring it back. So let's assume this is Euro AUD now. So Euro AUD price moved from 0 to 1.98760 to 1.99230. So now, if I say, what is the difference in pips? So the simple thing you just need to do is to do this minus this. So this minus this, who can give me the answer? So it's simple. Now you can take away this one out of it and use this 99,000, it's 99,230 minus 98,750. Okay, so let me do that with my calculator. This class for pips, we're going to do a lot of practical on this. When we start practicals, we're going to do a lot because you need to understand this one very well. So 99,230 minus 98,760. Okay, so now it's giving me 470. Now, the point is this: you have calculated this is 470, but you don't need this last zero. So what it is actually 47 pips. So this movement now is 47 pips. So it depends. Are you buying or selling? So that is why plus or negative will come into play. All right. So this is for the currencies without the JPY. Now, but the JPY pairs have their own counting because the JPY pairs are in 3 decimal places. So for JPY, we have like 112.657, okay, as prices, okay? Or you have 100.150 or 120. Those are the prices. So, and the JPY, let me give you an example of what I mean by the JPY pair. So we have the Euro JPY. We have the USD JPY. Anything that contains JPY is a JPY pair. NZD JPY, So these pairs actually are calculated. They are in 3 decimal places. So the pip is in 2 decimal places. So this last digit of the decimal, the third place of the decimal is not regarded. You can only bring it back after your calculation. So let's assume price move from 100.10 to 100.10 to 100.560. So what is the difference? The difference is just for you to do 560 minus 120. It becomes 440. But instead of you now to have it as 440, you now leave it as 40 because this 0 is not counted. I'm not sharing my screen. Jesu, are you sure? Hello, so I've not been sharing my screen. I'm just seeing all of this now. Share screen. I thought I'm sharing my screen. Oh. I thought I was sharing my screen. Sorry. I've been seeing all of this, but I didn't know. Oh, sorry. So I thought I was sharing my screen. We can't even see your screen, sir. Please share your screen. Can't see your screen. Oh, can see now. Okay, but at least you've been hearing all that I've been saying. I started with the euro. The other pairs aside the JPY are in 5 decimal places. Okay, any pair aside JPY, the prices are in 5 decimal places. But when calculating your pips, what you use is the 4th decimal place. So the 5th decimal place is irrelevant. It's called the pipette. And the pipette is not regarded in pip calculation. So when you are calculating your pip, you put the pipette aside. After you have finished your calculation, you can now bring it back to complete the 5 decimal points. Okay? So I made this example for, say, price move from 1.98760 to 1.99230. And if you do the arithmetic, it gives you 470. But now you want to remove the 0, so it becomes 47. So this movement is 47 pips. Now we are not talking about whether it's a buy or it's a sell now, but we are just trying to check the price movement and difference. Okay, so now coming to the JPY pairs, the JPYs are in 3 decimal places. Any pair with the JPY is in 3 decimal place, okay? And the pip is calculated with the 2nd decimal point, not the 3rd. So the 3rd is regarded as the pipette. So what you do is you take out the 3rd and so I gave these 2 prices, 112 to 0.165. Their prices are like this, 100.120. So I now say, okay, let's assume price move from 100.120 to 100.560. The movement is equals 440. But you now remove the 0, it becomes 44 pips. So now let's go to the charts. Let me show you what I'm talking about in terms of pips. Okay, let's go to the price. Let me show you what I'm talking about in terms of pips. Excuse me, let me check something. So let me go to Euro USD. Okay, so this is Euro USD. Now, this is Euro USD. Can you see the price here? Can you see the price? Let me see if I can increase my. So can you see the price here? Can you see the price? If you can see, just type on the chat box for me. Yes, I can see now. Can you see the price? The price of Euro USD? So this is the current market price now. The current price as we speak now is $1 12842. That is the current market price. Yes. Okay. I increase so that we can see it. So this is the pair. This is a pair without the JPY. So let's do Euro AUD. Euro AUD. So this is Euro AUD. It's loading network. Network is holding it. Let me refresh. Let me refresh. When it gets to this type, it becomes boring because okay, so this is Euro AUD. Can you see the price now? The same, how many decimal places? 5 decimal places. But in calculating your pip, you throw away the last one. It is called the pipette. So let's see JPY pairs now. Euro JPY. Anything that contains JPY is in 3 decimal places. Can you see now? The current price now is 163,009. It has moved to 163,110. Okay, so this is a typical JPY pair. So those are the two difference. Okay, so we'll be doing more of this tomorrow because we just tried to enter into what we were supposed to do tomorrow today. So tomorrow we'll have it broken down the more than what we have it now. So permit me to stop recording first here. Let me stop recording so that I can open the room for questions. Okay.